Hi, Assalamualaikum. We are from Group 4. We are going to present about topic 5, which is audit of inventory cycle. Okay, first, I'm going to present about introduction. Audit inventory of cycle is used to ensure that the financial statement is fairly account for the raw materials, work in process, finished good inventory, and cost of goods sold. Within the cycle, it can be divided into 5 activities which are obtained and recorded raw materials, labor, and overhead. The other activities that are such as internally transferring asset and costs, shipping goods and recording revenue and costs, physically observing inventory and price, as well as compiling an inventory. Okay, next, I will present about the classification of inventory. There are 3 classifications of inventory, which is raw material inventory, work in process inventory, and finished good inventory. For the first one, raw materials inventory refers to the basic materials that have not been processed yet. It is also not been used in the production of manufacturing firms. There are 2 categories of raw materials inventory, which is direct materials and indirect materials. Direct materials refers to the inventory that is used in the process of manufacturing goods. For example, like if you are producing a paper, the trees will be the direct materials. Otherwise, indirect materials is referred to the component that has been used to complete the manufacturing of finished goods. For example, like if a company is producing shoes, the leather and glue could be the indirect materials. Okay, next is the work in process inventory. Work in process inventory refers to the company inventory that is partially completed and still in the process of being prepared before it being sold. All the raw materials, manufacturing overhead, as well as labor that connected to each phase of the production process can be related to the work in process inventory. If the production process is more complex and takes a long period, the investment in the work in process inventory will be greater. Okay, lastly, I'm going to present about the finished good inventory. Finished good inventories refers to the inventories that is completely processed and it is available to be sold. All the raw materials and items in each phase of the production process will finally become a finished good inventory. The purpose of a finished good inventory is to disassemble the production and sales function so that there is no need to produce a good before sales. However, finished good inventory is a relative term where can also be a raw materials to the customer. So, I think that's all from me. Thank you.
Good day to Doctor. My name is Kongshun Zhuai with my lecture number 280650. Now, I will present the business function and flow for inventory. So the first step is process the order. The store manager or the computerized system will detect the amount of inventory. When they found that the inventory is low in amount, they will issue a purchase requisition to the purchasing department for requesting the purchasing of the inventory. Then, the purchasing department will issue a purchase order according to the purchase requisition to the supplier. After purchasing the inventory, of course, we will receive the inventory. Therefore, the store manager will inspect the quantity and qualities of the inventory compared to the vendor invoice that's sent by the supplier. After that, the store manager will prepare 4 good receipt notes. After that, the store manager will store the raw materials in the warehouse. Then, he or she will update the raw materials perpetual inventory master file. Next, step 4 is related to the production departments. The production department will issue a material requisition to the store manager. Then, the store manager will send the raw materials to the production departments. During the producing process, they will update the cost accounting records. The cost accounting record is to record the cost of activities incurred from the beginning of production until the end of production. It is to show that how much the cost will be allocated into the production and how the finished good will be cost. After the production process, the store manager will store the finished good into the warehouse. Then, the store manager will update the finished good perpetual inventory master file. Then, the store manager will also update the cost accounting records. Finally, the last step is related to the revenue cycle. The sales department will issue a stock release to the store manager. Then, the store manager will pick up the inventory according to the stock release and send them to the shipping department with the stock release. Then, the The store manager will update the finished good perpetual inventory master file and also the cost accounting records.
Assalamualaikum warahmatullahi wabarakatuh. My name is Zaid Muhammad Sokri and my serial number is 272910. Now I want to present my part, which is component of cycle. Component of cycle is the general of an inventory cycle audit is to ensure that the financial statement accurately account for raw materials, work in process inventory, finished good inventory and cost of goods sold. Within the audit inventory cycle, there are 5 components to consider. So these are 5 components of cycle. The first one is acquire and record raw material labels and overhead. The second one is ship goods and record revenue costs. The third one is internally transfer assets and costs. The fourth, price and compare inventory. And the last one is physically observe inventory. For acquire and record raw material labels and overhead, processing purchase orders, receiving raw materials and storing new materials are all included in this section of the audit. For example, each company's auditor gains a grasp of internal controls over these 3 tasks before doing control tests and substantive transaction tests. Ship goods and record revenue and costs. Recording shipments and related expenses costs are part of the revenue cycle. They are all included in this section. As part of auditing this cycle, auditors get a grasp of and test internal controls over recording shipments, including procedure to verify the accuracy of credits to inventory recorded in perpetual inventory master files. Internally transfer assets and costs. Internal inventory transfer and compares the process of goods and the storage of finished goods. Clients account this action in cost accounting records that are separate from other cycles and are audited as part of the inventory cycle audit. Price and compare inventory. Price tests are audit processes that are used to check these costs. An auditor, for example, must conduct inventory comparison tests to ensure that physical counts were accurately summarized and inventory quantities and prices were properly footed to equal the general ledger inventory balance. Physically observe inventory. Physical examination is an important sort of evidence used to verify the inventory's presence and count. To establish whether reported inventory exists at the balance sheet date and is appropriately counted by the client, an auditor must watch the client doing a physical inventory count.
Assalamualaikum and good day. My name is Amira Atika binti Abdul Aziz and my part is Major Controls and Audit Procedures. Inventory is a large part of the auditing process for company with physical goods. There are many complex accounting surrounding the inventory valuation. The companies have the temptation to overstate the inventory and thus overstate the assets. This means the auditor should focus on verifying the existence and valuation of the assets. These are 4 major controls in inventory cycles, so let's check to the audit procedures. Annual physical inventory count. The best way for the auditors to verify existence of assets is to take part in the physical inventory counts. Auditors should observe company inventory counts if at all possible. This is an excellent opportunity to understand the count procedures and become aware of any possible errors in their method. Second is perform cut-off analysis. It can be tricky for the company to accurate inventory counts when goods are constantly flow out from the warehouse. Auditors should ask the client regarding their procedures for halting inventory reception during the physical inventory counts. Auditors can also test the inventory received and shipped near to the date of inventory counts. If the inventory items were properly included and excluded from the count, it means the client have the good quality cut-off procedures. Next, test the inventory valuation method. Companies have the option on using last in, first out LIFO, first in, first out FIFO, or weighted average to determine their inventory value. Auditors should verify that the option stated on the financial statement is in fact being used in the accounting system. It's also helpful to verify costs associated with inventory. Auditors should compare supplier invoice with the information input into the accounting system to ensure accuracy. Last point is test all the inventory. Inventory that has been sitting long time on the shelves or lost some value. Quality products have spoiled, parts become outdated, and consumer goods can be out of fashion. Auditors should pay special attention to older inventory and perform valuation calculation. Under US generally accepted accounting principles, inventory must be valued at the lower of cost or market. If the company is valuing a product at higher rate than what's available on the free market, it probably needs to be written down. That's all. Thank you.
Hello doctor, my name is Niranjana. My metric number is 281507. Now I'm going to present about confirmation on existence and evaluation including physical stock taking. Auditor should attend physical inventory count to evaluate and determine the existence, completeness and accuracy of the count records of inventory. From the observation of inventory count, auditors can obtain knowledge on the reliability of the entity's stock take procedures. The inventory is physically counted at least once a year, which is performed at year-end date to serve as the basis for the preparation of the financial statements. In accordance to ISA 501, when auditor attends an inventory count, the auditor is required to evaluate management's instructions and procedures for recording and controlling the results of the entity's physical inventory counting. Secondly, the auditor should observe the performance of management's count procedure. Thirdly, inspect the inventory. And lastly, the auditor should perform test counts. The explanation for each activity is as following. For the first activity, auditor should evaluate the effectiveness of management's instructions and inspect how inventory count is being done. For instance, the auditor should examine whether the entity addresses slow-moving, obsolete or damaged items during the inventory count. For the second activity, auditor should observe whether the count procedures and instructions from the management are being followed properly by the entity's staff. For the third activity, inspection of inventory helps auditor to identify the existence of inventory and recognize any obsolete, damaged or aging items. Lastly, by performing test counts, these provide audit evidence whether the entity maintains accurate records of inventory. These also check whether the procedures and internal controls over stock taking are sufficient and if there are any material differences between the book records of inventory and physical counts, it should be corrected. Then the auditors are required to document the audit working papers as following. The auditors should record any material discrepancies from the entity's stock take report. Secondly, the sample size of the test counts. Thirdly, the findings and conclusions on the accuracy of the counts. And lastly, the general condition of the inventory. That's all from me. Now I pass to the next presenter.
My name is Ng Sijia. Metric number is 276964. I'm going to present about the price test. Auditors will be focusing on the test of the inventory cost, which can discover that the inventory cost is lower than the actual cost in the financial statement. The main goal of testing the pricing of inventories is to address the valuation and allocation assertion. There are three main areas that should be focused on to verify the inventory cost is recorded appropriately in company's financial statement. Firstly is inventory at cost. Auditors should verify the pricing techniques for raw materials and goods inventories such as FIFO and weighted average. In order to ensure the approach is applied consistently from year to year, the modifications in the method should be appropriately acknowledged. Besides, auditors must analyze the inventory acquisition cost by obtaining the original documentation, such as supplier invoice, to determine the price used in terms of their costing policy accurately. Secondly is inventory at net realizable value. To ensure that inventories are recorded at net realizable value, the auditor must investigate the basis for arriving at the recorded value, such as reviewing sales after the reporting period. During the physical count, auditors can observe the inventory on an alternative date to identify any degradation or obsolescence. Auditors also may compare inventory holdings to current or future budget turnover to determine excessive holdings. Last but not least is use of an expert. When entity assertions concerning the value of the inventory include highly technical matters, auditors may seek professional advice. In conclusion, auditors must understand the audit purpose and the company function connected to the inventories before proceeding with the audit procedure. It is necessary to prevent fraud, misrepresentation, and misleading or other inherent threats from the financial statement that will harm the reputation and image of the company and the user of the financial report. Hence, auditors must be alert and perform internal control over the inventory cycle by carrying out different inventory tests, such as tests of control and substantive procedures. These tests will also ensure the auditors obtain adequate evidence that the existence of physical and required inventories are appropriately valued. Therefore, auditors need to stress how to process and keep the inventory in public care by preventing new fraud within and outside the organization. That's all from us. Thank you for listening.